when I have not met someone in a social event or my morning walks or evening walks, when someone says, "Hey, I invested so much, I lost money." Investing in startups is not easy, and I'm not going to invest. I think all this happens if you do not build a thesis. And over the next 40 minutes, I'm going to give some broad ideas, and hopefully at the end of it, you'll have clarity on your first step is building a thesis. So hopefully at the end of 40-45 minutes, you'll have clarity on how to build a thesis, and then you can start your journey of becoming an angel. Let me start with this video. Have a look at this video. This is a video of a founder of Dollar Shave Club. Dollar Shave Club was started in 2011 by Mark Levin and Michael Dubin. And they felt a simple idea of why do you need to go every 10 days, 15 days to buy a razor? Isn't there a model where I get razors, shaving razors at my home, delivered at a prefixed time? I don't have to keep going. Subscription model they built in 2011, simple delivering razor blades to homes. And within 5 years, by 2017, 2012, they actually launched. They sold a startup for $1 billion cash. No big idea, simply sending razors to subscribers' home at a periodic time and getting subscription money. Listen to this inspiring video by this founder. Prakash, if you can't hear, just tell me, but I'm going to play the video.
Hi, I'm Mike, founder of DollarShaveClub.com. What is DollarShaveClub.com? Well, for $1 a month, we send high-quality razors right to your door. Yeah, $1. Are the blades any good? No. Our blades are great. Each razor has stainless steel blades, an aloe vera lubricating strip, and a pivot head. It's so gentle a toddler could use it. And do you like spending $20 a month on brand name razors? 19 go to Roger Federer. I'm good at tennis. And do you think your razor needs a vibrating handle, a flashlight, a back scratcher, and 10 blades? Your handsome-ass grandfather had 1 blade and polio. Looking good, pop-up! Stop paying for shave tech you don't need. And stop forgetting to buy your blades every month. Alejandro and I are going to ship them right to you. We're not just selling razors, we're also making new jobs. Alejandro, what were you doing last month?
Not working.
What are you doing now?
Working.
I'm no Vanderbilt, but this train makes hay. So stop forgetting to buy your blades every month and start deciding where you're going to stack all those dollar bills I'm saving you. We are DollarShaveClub.com, and the party is on. See you, Hi, I'm Mike.
That's an inspiring story of a founder in US. So what should your investment thesis broadly cover? You should have your own unique goals. Each of you is different. Each of your needs are different. Investment options are different. Circumstances are different. You have to define your unique goals and don't follow someone else's. This is not the stock market where you can say, okay, X has bought, Y has bought, so let me buy. You have to make your own goals. Very, very important that you do both of this. And you have to figure out how are you different. Are you based in a particular city? Are you in a particular age group? Do you have particular skill sets which you can bring to the table? Your investment is from your hard-earned money. So it's never easy. It's never easy. It takes time, it takes effort to figure out a thesis and on basis of make that investment. And you have to also decide what kind of investments you want to make. Do you want to make small size investments? Do you want to make sectoral investments? Why do you want to make it? Why now? Why not wait? Why not wait after 1 year, 2 years, 6 months, 8 months? All of these are very critical questions which you really need to start answering before you do it. And you have to act consistently. Whatever thesis you decide, do not change it immediately. It's, of course, a living document, thesis. You should relook at it from time to time. But once you build a thesis, go with it. Suppose you build a thesis, I am going to invest only in fintech. My friend Lalit, who's on this thing, and he says, Lalit comes and tell me, I've got a great agri-tech idea. Doesn't mean I have to do it. It doesn't fit in my thesis. And of course, this cannot be a speculation, because it doesn't, you can't open the papers in the morning and see the value of your portfolio investment in startups. So this is something I found. I just thought I'd share with you. A reasoned argument for particular investment strategy backed by research. In the financial world, analysts may prepare formal document. So in large corporates, financial companies, they have a formal document. But for you as an individual, there's no harm writing it down, even if it means 2 lines, 3 lines, 4 lines. Coincidentally, I have written an article, and it just got published 2 days back in the recent latest issue of Business India. And some of the points which I'm covering here are written in the article. So in case you want to revisit what I've said, you don't need to struggle. You can only open this Business India and check my article. Of course, I posted it on my LinkedIn page as well. So feel free to read it, comment on it, and most of what I've said is there. So you can always read it and figure out what I've said. So this is a very interesting example. Ritesh Agarwal was just 17 years old when he came to pitch and raised money for Oyo Rooms. The parent company's name was something else, Oriole Rooms. But at age 17, he started pitching. So at 100x, we fund early stage startups, and we get 17 years old, 20-year-old, 19-year-old. It doesn't matter. Today, very young people also come and pitch. So in 2011, Ritesh offered 15% stake to Vishal Gondal, and Vishal is himself a investor, entrepreneur, a celebrated entrepreneur, founder of Goki, and he has himself admitted, Vishal, on newspapers and channels, he was offered a 15% stake for 30 lakhs rupees. Now, if he had invested, Vishal said no to him. And if he had invested that time, today it would have been worth a couple of 1,000 crores. Within, from 2011 to now, 2020 to 11 years, couple of 1,000 crores, the same 30 lakhs which he invested. So this is the magic of angel investment. Sky's the limit to what kind of returns you get. So your investment thesis will help you trigger your behavior. You'll get aligned accordingly to networks. So if you are, based only on particular startups, particular size, you'll start meeting the networks of angels who are aligned to that particular thesis. It gives you focus and the momentum which you require to build a winning portfolio. In a startup world, we always say you invest in 1 or 2 startups, you're not at all guaranteed of earning any money, or in fact, you'll probably lose money. But if you look at it as a portfolio investment, invest in a couple of startups, few startups, more startups, you are then building a portfolio. On a rough basis, in the financial world, it is said that if you invest in 20 startups, you're more or less guaranteed of getting the money back. So less than that, that means the probability of losing the money is very high. And of course, if you invest in 50 or you invest in 100, the probability keeps growing. This is just a rough benchmark. Doesn't mean that it's universally applicable. You could invest in 2 and hit jackpot. You could invest in 25 and may not hit anything. But as a rule of thumb, this is in the financial world taken as a rule of thumb. It has to be a living statement. I mentioned earlier, of course, get guided by it, but you need to revisit it every 6 months, 12 months, update it, because technologies change, consumer behaviors change, a lot of things keep moving. You're putting your present cost into the future and a future benefit into the present by investing in startups. So it is not an easy decision, but it can be a very exciting decision. So there's a difference between rudders and oars. Rudders is direction which you get. So thesis is the rudder, whereby you get the direction. Without the rudder, a boat cannot move. So without thesis, you should not invest in any startup. Zero. Don't just blindly invest because a neighbor or neighbor's dog tells you to invest. Oversee the progress. And when you invest in startup, the beauty of it is you get a chance to, in most occasions, to interact straight with the founder, understand what is happening, understand the progress. There is, of course, a formal system of quarterly reporting, monthly reporting, whatever, but you get a chance to interact. If you invest in public markets, there is almost a nil chance to directly interact with the managing director. I have run a public listed company, and individual investors will rarely interact with 5 lakhs, 10 lakh investment. You don't get a chance to invest. So your thesis is your rudder. You have to do that first. Prakash, Saurabh, can you put the poll number 1? Is it possible?
Yes, sir. Yeah.
So please participate in this poll. We are going to launch it soon. Yeah. So what is important when investing? Is it a winning idea or strong execution? What do you look at it when you want to evaluate a startup? Please quickly respond. It'll be interesting. I just thought there'll be some interaction even in the online Zoom world we are living in. It's interesting. There's no right or wrong answer. It's all depends on what you think is the right answer. Okay, I'll hold it for another couple of seconds and then stop. So great. So 71%, a large majority thinks, you can end the poll, Prakash. 72% thinks that execution is important than winning idea. I would tend to agree. Again, there's no right or wrong answer, but yes, I would tend to agree. Can you take off the screen or should I just close it? Yeah, I would tend to agree. Strong execution is important. It starts with the winning idea, but of course, at the end of the day, if you have to make a choice, execution is more important. So there are various types of startup investors. Do you identify yourself with any of these? You should look closely at the screen and figure out, are you a trend focus? I'm going from the right and coming towards the left. That means today, there is Web3, metaverse, crypto is a big trend. Are you focused on saying that I will ride the latest trend? A couple of years ago, it was IT, then SaaS, and today is Web3. Are you sector focused? So do you have experience in a particular sector and say, no, I will only go on agri-tech, but that's what I understand. Are you thesis driven? That means, within certain boundaries. No, I will not invest more than 10 lakhs per startup. I will not invest in more than 20 startups. I will not, I will invest only in Indian startups. I'll invest in early stage. I'll invest in pre-seed. All these things you have to look at. And the extreme left is opportunistic, anything and everything which is interesting. You can be any of these things, but you have to make up your mind where you fit and then follow that accordingly. How do you know if your investment will generate great returns? It is not easy. I will give some kind of guidelines based on my experience, but obviously, when you invest in startups, you are looking at generating asymmetric returns, unlike other modes of investments. When the founder comes, so imagine Ritesh Agarwal pitching to you at age 17, and I have had young girls and boys pitching at age 17, 18, 19, 20. How do you make out that will this person become a great leader? There are stages of a startup. When at the pre-seed or angel stage, it is so small. There's just 2-3 people, maximum 4 people. When the company grows, will this founder become a leader? Very, very important. But how do you judge it? There's no hard and fast rules. You have to just talk to the person and figure out. Will you continue holding after a huge gain? That means, let's say you get an exit at Series C or B or whatever. Will you exit the entire amount that you've invested? Will you disinvest half, and if it goes to the next level, will you sell or will you double down? Valuations of course grow. Suppose you invest 20, 30 lakhs, 40 lakhs at Angel, and suppose the company does well, it goes to pre-series A and series A, of course the valuation will be much greater. Will you double down with saying, this is a winner, I'm going to invest 50 lakhs more because I think this is a winner? Or will you take out half of your investments? You have to be very clear and stick to it. At 100x, just to give you an indication, we are a VC firm, of course, SEBI registered. We do not invest beyond our initial investment. We are very clear. Even if the person is, we feel, a winner, we do not double down on investment. But as an individual, you need to have these parameters very clear in your mind. No matter how much due diligence you do, your initial investment is beginning of the journey. You don't know what happens. There are so many moving parts. Of course, recently you've heard of governance issues at startups. All these things will happen. There's unknowns are there. You also have to remember how much liquidity you want. Startup investments are generally, 99.9% not liquid. If you invest the same money in the public markets, you want some money urgently, you will get liquidity. How much liquidity do you need? Do you need to keep some amount? And how much do you want? Both these parameters are important, and you cannot invest money in startups if you need that liquidity. It will be a wrong move to do that. So what is a good investment idea? People keep asking me, Ninad, what's a good investment? This is very different for different people. What is good for me may not be good for you. What is good for me may not be good for Lalit. But if all of us agreed it's a good investment idea, everyone would fund the same startup. So this is a very critical parameter. But I'll now, in slides to come, give you some broad parameters on how to evaluate startups. So this is first and most important. How much should you invest? You have to make up your mind. You have an X amount of money with you. You are, let's say, 25, 35, 45, 50, or whatever. And at each stage, you have different requirements of money. You have to firstly define the total amount you'll invest in startup. Do you want to start with, let's say, 5% of your total portfolio to be invested in startups, or less than that, and maximum go to 10%? So that is the first broad limit. And then again, you have to decide how much you're going to invest in each startup. Are you going to, suppose you have, let's say, you say over a period of time, I'm going to invest 2 crores in startups, hypothetically. Are you going to invest 5 lakhs in each? Or are you going to put 1 crore in one and 1 crore in another? This is very critical for you to decide. When you invest small amounts, in the VC world, we say spray and pray. You spray your investments and you pray. Suppose you invest 5 lakhs, obviously you get much larger numbers of startups, and you hope that one of them will grow. So total amount and limit on each investment is critical. Then you have to also develop frameworks, set of guidelines, and what are you expecting? Are you expecting, of course, first the money back, and 2x, 3x, 10x, 100x? Again, all this is connected to the number of startups you invest. In the startup world, if you invest in 20, you more or less get your return back. After that, you start getting 2x, 5x, 10x, 20x returns. So startup world is you have to identify the nugget in the pitches you get. You will, once you become an angel, you will get a lot of pitch decks. As a firm at 100x, we get close to 15,000 pitch decks every year. So we go through a lot of pitches. So how do you identify the chef and the cook? Obviously, Sanjeev Kapoor is a very renowned chef. So you have to figure out at that stage itself, who's a chef and who's a cook, because you would rather put your money behind a chef than a cook. So this is also an interesting slide. The stage at which you invest and the risk are directly proportionate. The earlier you invest, the higher the risk, because there's no traction. There's no way to judge, how it is going to go. If you invest in a pre-seed round, you basically do, putting it on a product, seed round on the team, angel round, some level of business, pre-series A execution, series A scale, series B growth, series C valuation. So, people who go further down the track, they have some metrics, some numbers to figure out if this business is going to grow. But the earlier invest, you'll get a far lower valuation. Remember the story of Oyo Rooms. In 2011, Vishal Gondal got to an offer of investing 30 lakhs or 15%. It would have been worth a couple of thousand crores. So that was very, very early. So these are the steps in decision making. What is the message you want to give to the startups and the ecosystem? If you decide to start investing, you have to broadcast saying, I'm an angel investor. And you figure out, do you want to join the network? Do you want to look at pitch decks from firms? Do you want to go to a local? In each city, there is always some network of angels. You can meet them. What kind of startup entrepreneurs you want to invest? Very early, you want to age. You say, no, age doesn't matter. How many investments you want to make, around what time? Do you want to make 20 investments in a year or 20 over the next 10 years? Tracking them, generally you get reports from these startups regularly. And exit, it is not, exit generally will not happen earliest, very earliest possible is 3 to 4 years. So it's a minimum 5 to 7 years is what you need to think through as a potential time you'll get exit. So you have to have that time frame in mind when you start investing in startups. Prakash, can we have the second quiz, please?
Yes, sir. Yeah.
So what should founders be obsessed about? Can you give your response? Perfecting product or satisfying customers? Again, it's your perception. Okay, so 75% say satisfying customers. Yeah, more are coming in. Let's wait. Okay, let's keep it open, Prakash, for some time. 20 more seconds. So, well, you can see this interesting response. 68% feel satisfying customers is what founders should be obsessed about, and perfecting product. So I'll tell you my experience. I tell this to founders all the time. Do not fall in love with your product. And this happens, across all fronts, whether you're doing a finance product or tech product, you want to make the best product. You have to do a good product. It cannot be substandard. It's always a WIP, work in progress. Satisfying customers is always more important, and founders need to focus. So if you are investing and if you sense that the founder is really just mad about only product and not looking at the market, customers, what benefit customers get, you need to be alert and remind the founder that you need to look at customers. So to develop your thesis, your knowledge of a particular sector really is important. If you have for your lifetime worked in manufacturing, you might want to just work in manufacturing and invest in those startups. Your investment perspective and your interest in angel investing. See, angel investing is a long journey. It is not a one-off thing which you do and forget about it. It's a journey which sustains you. If you invest in, let's say, a dairy product, you will yourself start reading more about it. It tickles your mind. It keeps you interested in that industry. So what is the outlook to angel investing? What is it? When you're investing in doing angel investor, should you think rather, what can go wrong? That's typically any investment decisions you take. This is how Of course, debt is given. What can go wrong? And based on that, you take securities and you take all kinds of things, guarantees. You don't have any securities guarantees in angel investment. It is equity investment. If you lose the money, you lose it all. Rarely you get some money back, but you can lose all the money. So do you think of what can go wrong? This is typically how your mind is trained to think and believe on any investment decision. But we do always, when I think as an investor, I always think what can go right. If this can go right, it can become a big company. I'll give you a simple example. We invested in a company called Kerala Banana Chips. They were there in Shark Tank also. In 2019, they came to us. They are making banana chips made from a Kerala banana called Nindran banana. Very tasty. But if you step outside your office, you'll get thousands of people selling banana chips on the roadside, fried on the road. So they said we are bringing the first untouched by hand, hygienic, tasty, healthy banana chips in a packet, Kerala banana chips. We funded them. They are reaching, around 2 crores revenue a month this now from 2 lakhs just 20 months back or 18 months back. So at that time, you could have thought, what can go wrong? Everything can go wrong because, it's a competitive space. There are cheap options available. But we thought, what can go right? We thought, yes, people might want something delivered at home. 75% of sales are online. And it's worked out right. So it's a different mindset. You might think, this is so easy. What is the basics? It really, really changes the way you think of how to invest. Not what can go wrong, what can go wrong, but what can go wrong, right. So poll number 3, please. Is capital chasing ideas? What do you think? Yes or no? Poll will come up. Good old days, ideas always chase capital. Has the reverse happened or it's still the same? Okay, that's interesting. I can see the trend. So it is, majority of you feel capital is chasing ideas. I would tend to agree. Not all ideas get funded, not because they're not fundable. There could be various reasons. But today there is so much amount of capital chasing ideas. And the beauty is ideas are with people who do not have any means, and yet you can get funded. Ritesh Agarwal was nothing when he got funded. We are funding people who are with such humble backgrounds. No one asks them, give your assets, nothing. It's a simple equity funding. And there are others chasing them as well. So I think the world has changed a lot. Really speaking, capital is chasing ideas. And you do start doing angel investment, you might sometimes be surprised. Say, I'll give 5 lakhs, 10 lakhs check to a founder. He'll say, yes, yes, yes. And suddenly, after 10 days, he says, sorry, I can't take the money. I've already, round is full. It happens all the time. So don't be surprised with this kind of attitude of founders. So I'll spend the next 3, 4, 5 minutes on how do you evaluate startups. And I'll share you my thoughts. There is art and science to it. I'll tell you the science part of it. Art you learn as you go along. And it's not difficult at all. But let me explain to you the some of the things which we see. What is the reason for starting this startup? This is so fundamental, and ask startups all the time. What is the problem you're solving? You may think you have a damn good product, but are you really solving a problem? Are you just building a product because you think this product is required? This articulation is very critical for a founder and the solution which they have. And what is the potential of the market size? If a person comes and tells me, I'm building a startup to make multigrain bread for South Bombay who only love this multigrain bread, I'm not saying it's a bad idea. It's a great business idea. But is it startup? Because we at startup, you have to look at ideas that can scale. There's very different between a business idea and a startup idea. Business idea is you do well, you earn yours for yourself, your family, make it profitable. Startup is a business idea which can scale. It cannot scale if the potential market size is small. What is the addressable opportunity and focus? Is the person at the seed stage, the focus has to be very narrow, uh, you know, inch deep and a mile long. It should not be trying to do too many things. You can't have 20 products at the seed level. But yes, whatever you're doing, the market size has to be large. And what is the positioning and segmentation? Why do people want this product? Is it a vitamin pill or a painkiller? Vitamin pill, you may or may not have it every morning, but a painkiller certainly, you're solving a problem. You will need to have the painkiller. Uh, does it fill a vacuum? And can it have a non-linear growth? Virality is important. So, the last point is important because you can't say that, okay, I am spending 1 lakh on marketing and I'll get 2 lakhs revenue. I'm spending 2 lakhs on marketing, I'll get 4 lakhs. I'll spend 4 lakhs, I'll get 8 lakhs. It doesn't work. If that's the way it's going to happen, it's not a non-linear growth. There has to be some element whereby a non-linear growth is important. Remember, you have to back startups which are painkillers. They're solving a problem, they're filling a vacuum, and they're viral. And is the timing correct? When obviously COVID hit us, obviously you didn't invest in startups which are dealing with products and services which are not in demand, tourism, unfortunately, or some of them. But yes, the present state of the economy is very important. What is the enabling technology? You have to learn what are the futuristic technologies which are going to come and how they impact the startup and the cultural acceptance. Where is the startup now? Is it just on a concept, or has it started something? Do they have an app developed? Is it live on Play Store? What are the metrics? What are the downloads? What is the capital? Has the startup founder invested some money, couple of lakhs, or not invested at all? And what is the team? So this is critical. Sometimes you find 2, 3 start founders, all of them same skills. They're all tech founders. This all of we three code together. But that doesn't, that's just not good for a startup. They have to be complementary skills. And there are sometimes 3 marketing guys, and tech is outsourced. It's very tough. The team needs to have complementary skills. And if not, what are the competency gaps, and figure out how these gaps can be filled. Why isn't everyone working on it? What is the competition? There are very few ideas which are totally unique. It's not necessary that it has to be a very, very unique idea. It can be a Me Too idea. It can be something which someone else is following. But, how is this execution happening? What is the unfair advantage on it? And what is the entry barrier? All these are important to know. And what is being done better? What are you doing which is better? Is it execution? That also is important. I gave you the example of Dollar Shave Club, where the whole thing was based on a different model of business. There's no new product, absolutely no new product. Are you doing better delivery of the product? Do you have a different business model, go to market? Today, the big thing is D2C, direct to consumer. Do you have a direct to consumer model? So the advantage of D2C is, unlike going through a distribution channel or through an e-commerce channel, is that you own the customer right from the journey of coming, ordering a product to fulfillment, and then upselling, and then of course reselling. So obviously it's a different model. In the D2C space, you're going to see a lot of action in India. Can we have the poll number 4, please? What do you think a startup founder should be, a mercenary or missionary? Please put your responses. Wow, this is looking equal. Okay, I think missionary is more people have responded. So yes, I would tend to agree. Probably you have to be mercenary up to a point. Maybe at the very early stage, you have to say, no, I'm going to just go and grab this opportunity. And then at the future point, probably you have to be on a mission. Missionary is a right, according to me, there's no right or wrong answers. Each one has their own perspectives. So what are things we see and you should see? First and most important is the founding team. In the startup world, in the VC world rather, we call it the jockey and the horse. The founding team is the jockey, and the market size opportunity is the horse. So market size has to be large. If it's a tiny market, it is not a startup. There's a big difference between running a profitable business and doing a startup. What is the business model strength? Is it a new go-to-market? Is it a new subscription model? And what is the moat this startup has? And we do not invest unless we feel we will get a minimum 20x returns. Does not mean that each startup we will get. But if we feel that, oh, we'll just get 5 to 10x returns, we do not invest. So this is our thesis. You should borrow, you may borrow, and not should, you may borrow some of this to make your own decisions. Founding team is the most important, and then the balance follows. So let me show you a video of Under Armour and then talk about how this company was formed in US and how it's become a big success.
There's a fog out there. And it's calling you by name. Wants to wrap his whole self around you. Make you forget who you are. Make you forget the work. But you won't forget. There's only one.
I love this video. Under Armour story is fascinating. You can check it on the internet. I'll tell you in just 60 seconds. 1996, it was formed by a person called Kevin Plank. He was a fullback in Maryland University football, the US football. And you notice that after every game, he has to change his t-shirts or undershirts 5-6 times. So to carry a backload of sweaty undershirt, he said there has to be a solution. So he experimented and made a new kind of cloth which absorbed all the perspiration. And after that, you don't need to carry all these 7-8 undershirts which are sweaty. Gave it to his teammates, became a huge success. From that, it is now a $7 or $8 billion company, US company. They have just recently entered India. What is the problem he is trying to solve? Sweaty undershirts. Just an amazing story of startups form can become so big. And here are some potential red flags people like us look at. Are the founders full-time? You have to ask this question direct and straight. We get various answers. We get, no, I'm full-time committed to the startup. Doesn't work. No, I'm working here, but my 80% of my time is here. I am a founder in another startup. It's on, it runs on its own. You should not invest money if the founder wants. Absolutely, we are very clear. So again, let me put it this way. It's our thesis, but I would suggest you should not invest in a startup where founders are not full-time, because you're putting your hard-earned money in that startup. And startup's attention is divided, it doesn't work. Single founder is yes and no. Ideally, there should not be a single founder, and ideally, there should be a tech co-founder. Today, everything is tech. You may or may not get the opportunity, but ideal situation, you should not invest in a single founder. There are risks involved, and in ideal situation, there should be a tech co-founder. Salary is a very sensitive thing. Startups, founders obviously cannot, if suppose Again, I'm talking about BITS Goa because I saw Lalit in the beginning. If you're graduating from BITS Goa, you would get X amount of salary. You do a startup, you cannot draw the same amount of salary. You have to draw just a small sustenance amount. And sometimes they will tell you, after you fund me, I'll draw a large salary. It doesn't work that way. You should be, keep your mind alert. Just because you're funded, you start drawing a large salary, doesn't work. Startup is a journey of wealth, not a journey of income. Founders should know that. You will not earn the same income which you earn outside. And is the tech outsourced? Ideally, it should not be. If a tech is outsourced, it also becomes a issue. Tech, there should be a tech person within the startups. So there are a lot of reasons why startups fail. Let me talk about this living dead company. Somewhere in the middle, you see. Living dead company is a company which does not scale and does not fail. It's somewhere in between. It's growing at 6-7% annually. They're doing good business, profitable, minor profit. You will never get an exit. The company will continue like that, and we call it a living dead company. As an angel investor, you need to want to invest in companies which really scale a lot, and you get exit because it scales a lot and it gets a great valuation. So there are a lot of other areas, which I've, put it based on our experience. Perfectionist is good, but doesn't work in scaling. Team building is important. There's these Superman founders, who think no end to themselves. They are not coachable. They don't listen. They don't trust anyone. It doesn't work. Finance and governance is becoming increasingly important. A lot of startup founders do not come from that background, but there's nothing they cannot respect or learn. It's becoming more and more important, so they need to do that. If you also raise too much money too soon and dilute your equity, from a founder's perspective, it does not get fundable at a later stage. Remember, your thesis is your market strategy. Build your thesis, and that becomes a market strategy. I'm now coming to the close of my session. So if you have any questions, keep them ready, put them in your chat. I'll take them once my session is over, next couple of minutes. And your thesis is a set of beliefs written in words. Take a pen and paper, pencil and paper, and write it. It helps you remove some of the emotions. Your decisions should not be emotion-based. You lose a deal, you lose it. You do not invest. Vishal Gundal did not invest, and he lost a great opportunity. It happens. In the VC world, we call it anti-portfolio. So we have said no to so many deals in our firm. I'm sure after 5 years, some of them will become big. And that's it. You can't help it, But at that point of time, without any emotions, you have to take a decision. Don't be swayed either positively or negatively by emotions. The thesis helps you pitch. You'll be surprised that even if you're willing to invest, let's say 10 lakhs, 50 lakhs, you have to even pitch to the founder saying, oh, why should I take you on my cap table? It happens. If you're already an investor, you must have faced it. But if you've not done it, it happens all the time. Founders also say, okay, my cap table is full. Why should I take you as my investor? So be specific. Specific of the amount you're investing, time frame you're looking at, the sectors you're looking at. All of these things have to be very specific. And again, I'm repeating this, but how much fund you want to put in over a period of time, your investment period, and your risk appetite. If you are okay with high risk, very early stage, pre-seed stage, you can invest. If you're not okay with high risk, invest a little bit later, but your returns are proportionate. If you invest very early, the chances of getting asymmetric returns are much more. Here it is. The earlier the stage, the lower the valuation, the higher the risk, and the higher the returns. You can join a syndicate. There are syndicates all over the country. There's a lead investor, and the lead investor says, I've got this startup. You want to join as a syndicate, you can join a network, or you can do it individually. If you're doing it individually, put it on LinkedIn saying, I'm an angel investor, and start getting pitch decks. You can decide how you want to do it. And location, wherever you're located, each major city, there are groups of angel investors. They meet, startup investors now to meet regularly is in person is not easy, but digital meetings are acceptable. Again, you have to decide there are opportunities everywhere, and you can invest money outside of India legally. You have to decide, will you do only India or will you take anywhere from around the world, cross-border deals? At 100x, for example, we invest only in India because we feel let's handle only India domiciled startups in case there's an issue. And the last poll, funding should be based on need or greed. You can start posting your questions. I will take them as soon as this session, my presentation is over, next couple of minutes. Prakash, please put up the poll. Fundraising should be based on need or greed. Well, large majority is need. I agree with you, but sometimes greed takes over. Let's end the poll, Prakash, and I'll move on to the next slide. I mentioned about the sector. More important is the negative list is what you need to figure out. You can get into finer details to narrow the list. What are the annual revenues, ARR, monthly recurring revenue, user growth, month on month, what are daily active users, monthly active users, retention, churn in customers. This is assuming the startup has a little bit of traction. If they don't, of course, you can't do any of this, but when there's traction, you can check. So what is your secret sauce? You have to figure out. It's not just money. Founders don't want just money. Remember that. You might want to cut a check of 50 lakhs also. They will not take it mostly unless there is something else other than that. What is it? A domain expertise? Do you have a network of friends? Is it your ability to double down on successful startups? Founders look at all of this. They want connections. They are young generally. They want domain experts. Yeah, there is one more poll. Should a startup founder hire for attitude or skill? Should startups hire people for attitude or for skill? Wow, it's running almost equal. Okay, this is closer than any of the earlier questions. 57%, 43. Attitude or skill. You can end the poll, Prakash. Thank you. Startup generally attitude becomes more important than skill, but both are important. So these are Fireside Ventures. It's a consumer VC fund. So on the website also, they have clearly, you see these images, it's a consumer fund. So, you can also change your LinkedIn profile based on when you decide to become an angel investor. You can announce, and you should, that you're a startup investor. You'll start getting pitch decks directly. People are crawling all the time on LinkedIn, startup founders, and you'll start getting pitch decks. But don't announce and not invest. Announce only when you're ready to invest. You can write clearly, I'm looking at investing seed stage, write to me, email, and then getting. So welcome to exciting journey of becoming an angel. I covered a lot of ground. I could have gone on and on, but I realized that I shouldn't speak for more than 45, 50 minutes. I've spoken for roughly 50 minutes, 55 minutes. And I'm already seeing some questions in the chat. I'm on LinkedIn. You can always connect with me. And welcome to it's an exciting world. It is so exciting. You get consumed by it. You will start enjoying it. You'll start tracking the company. You'll start interacting with the founders. And, over a period of time, it can be really rewarding. So all the best, and I'm going to stop sharing and look at now the chat. Okay. So what kind of X in 3 years is considered right? So in 1 year, 0x, you can't expect any returns in 1 year. 5 years, you should look at a 20x return. 3 years, again, is not a good enough horizon. What amount of investment is typically sought? So, it depends. If you're in a syndicate, they take even 1 lakh, 2 lakhs also. If you're investing directly in the startups, generally 5 lakhs, they may take 2 lakhs, 3 lakhs, but generally 5 lakhs is the amount they look at. How many investors come into this? So in a syndicate, let's say, I'm seeing Ashok, let's say Ashok builds a syndicate, he likes a startup, let's say in the agri-tech space, and he says, okay, I'm going to get 1 crore investment. He puts in 20 lakhs, so he becomes a lead investor, and he takes others along with him who can invest 5 lakhs each. So these are very flexible numbers, but I think if you want to invest 1 or 2 lakhs, generally you have to go through a syndicate is better. Even angel networks are there. Networks have their own way of operating. You can go through that. How would a good investment thesis define sectors? Sector agnostic. I think, your sector part, you need to decide on there are 2 ways of looking at it. Let's say Ashok says, because I know him personally, sorry to keep poking at you, Ashok. I hope you'll forgive me. But Ashok has been in manufacturing all along. So he'll say, no, I will invest only in manufacturing. That's one way of looking at it, saying I'll keep. But the other way is saying, no, bloody hell, let me understand Web3 and let me get into other horizons. Why only manufacturing? He feels strongly for the country, which I know he does. And says, okay, agri-tech, I need to invest in agri-tech, but that has a big impact. So the moment you start expanding your thesis beyond your comfort zone, you will start reading about it and getting more educated about it. What are a negative list for an investor who's getting into investment space? See, negative list is, suppose you feel that, I'm just throwing an example, in the fintech space, the regulations are changing all the time, which they are, but you say, I'm not comfortable with that. Okay. There are 2 ways of looking at it. One is, all of us know Uber had to pitch, I think 30, 40 times before they finally got an investor because, or even for that matter, or other companies. So you may think, no, I don't want to get into this space of, or you may say, no, this is a gray area. Let me, there's someone will make money out of it. So these are negative lists.
Thank you, Nima.
I have done angel investment experiences that meetings co-founders very tough. Yes, it is. See, Ashok, I think that's a question. It is not easy to meet founders, but that's how you have to start building a rapport. Founders behave differently at different phases in their career or in their fundraising. At the pre-seed stage, of course, you get a lot of time, but at the moment they go on to Series A, Series B, and all, they get big funds coming in, and your role by definition gets limited. So, I think that's why you have to not have emotions in all this. As long as you're getting some reports, keep doing it.
Thanks.
Support from right mentor can impact vision. Yes, it can. I agree. If your mentor is not right, I always joke it becomes a tormentor. So getting a right mentor is very important. But also important is if you are investing in a startup and the guy has, unfortunately, and this happens all the time, or the girl has given very high amount of free equity, we just do not invest. A mentor who gets free equity of 10%, 15%, it's just impossible for the startup to raise next round of funding. You have to be cognizant. See, these founders, the only asset they have is equity. They start giving equity, saying that, no, this guy is the best guy in this field. I've given him 15%. He gives me 1 hour a month. It doesn't work. Mentors have to be given very, very small amounts of equity. And that's because the founder cannot raise future rounds of money. There's no equity cap table left. Is past performance representative? Mainly, whom do you trust? And then, yes, past performance is something we should always look at. But investing in startups is not about investing basis of a trend. This has happened, this will happen. That's why I said the most important decision you need to take is what can go right, not what can go wrong. It might sound very simple, but I keep repeating this all the time in my head when I'm taking a decision. As of angel, you have to think what can go right. If Oyo could become a couple of thousand crores after 30 lakhs of investment in within 11 years, the question was what can go right? There are hundreds of things which could go wrong, and on the basis of which you do not invest. We are looking for, connect with me on LinkedIn if there are any specific questions. I'll respond only to general questions, not to very specific. By when will fintech valuation subside? Will it impact in this? See, valuation is a very different different game, and I could spend 1 hour discussing it. But in brief, startup valuations, the good thing is now, IPOs are allowed. So eventually there is an exit for startups in terms of IPOs, and it will go through its own process. One can argue what has happened and why it has happened, but it goes through its own process. But it's a public discovery of a price. Before we reach that stage, in the angel stage or pre-seed stage or pre-series A stage, valuation is not a science. Most of it, if not all of it, is determined by what amount is to be raised at the next level. Do you want to raise 20 crores over a period of next 2 months? Next 2 years, 3 years? Then how much will you dilute for that? So a lot of things, determine the valuation. It is not the valuation which you've learned traditionally, that this is the future cash flow multiple. It doesn't work that way. It is all, sometimes we call it momentum valuation, velocity valuation. These are different ways of looking at it. Should strategy be, Gagan is asking, invest and forget? If not, how often should angels check on? No, of course not. Not invest and forget. I had said pray and spray and pray, which is, you invest in a lot of startups and then hope one of them makes it big. But yeah, you should track it. You should track the category, what's happening to it, and you should insist on quarterly reports or monthly report, whatever the founder has promised to you in your shareholders agreement, or we generally invest on iSafe notes, on the safe note. You need to ensure that that is there. Your access to the financial information is important, and of course, so most of these founders, you're always available on phone calls and you can schedule a call. I'll take last 1 or 2 questions because I think we have just got, there are 2 questions. So they're fairly long questions. Panit Trivedi says, besides financial consideration, can angel investment by established industry also benefit strategic value? What is, there is a model called corporate venture capital, which is a very well-established model in the Western world. In fact, as a startup committee, we had a session, and Swati was leading that effort, where large companies set aside money to invest in startups. And they can have a thesis, we'll invest in money in startups connected to my area of work. And it's a great idea because you can track the new ideas. Innovation is even a large company does not have monopoly on innovation. Innovation can happen everywhere and it's happening everywhere. So you can come across innovative ideas, you can track the ideas, and as you go along, you can increase the stake and sometimes even buy the company. So yeah, corporate venture capital is a way in which you can do it. So that requires a very different thought process. Running your company is very different from running a CVC fund. Very, very different. You require specialized people running that. So I think there are some personal questions I'm going to skip. I think I'm more or less covered. Let me summarize my thoughts. There is a big opportunity for angel investment in India. There is a lot of startups. Just to give an example, not to boast about 100x, and on 16th, we had a open house where we said, first 75 startups, we will allow them to pitch directly to us. We had a massive crowd over here. 300 people landed up. People came from Siliguri and Delhi and all over the place, So there's no shortage of ideas. Today, you go to a college, particularly engineering college, you ask the students, how many of you want to join a startup or start a startup? Believe you me, 80% people will raise their hands. People are wanting to join startups. So there is a massive flood of ideas. So there's no shortage. And here is the opportunity for you. Invest in early stage only that amount of money which you will not regret losing. If you're going to regret losing, do not invest. So invest only that part of money. Once you start getting returns, you can start looking at reinvestment. It can be very exciting, very exhilarating. It can cause you heartbreaks also when you lose money, because it becomes binary. It's not like a stock market where, at least thoda to paisa aa gaya, the market price might fall. You can have to kiss the entire money goodbye. But if there is a moment to become an angel, can you become? The best part is you become an angel in a lifetime. You can call yourself an angel. Isn't that wonderful? And if there's a time to become an angel investor, it is right now. So thank you again for joining this CII session. I hope all of you benefited. And if you want to reach out to me separately, I'm on LinkedIn. Thank you. Thank you. I'm seeing some familiar faces.
Thank you, Nina. Thank you. Nice
Yes.
meeting you digitally. It's been a while since we met now, but I'll see you soon.
Thank you. Thank you. Thank you.
It's a wonderful presentation as always.
Thank you, sir.
Thank you. Thank you, everyone. Thank you. I'm glad to have such an audience. Thank you. Thank you. All the very best.
Thank you, sir.
Thank you.
Thank you, sir. Thank you very much.
Thank you for your comments. Thank you.
Thank you, sir.
क्या कह रहे थे वो अभी Saturday?